Silver just sent a warning, not a headline, not a prediction from some analyst on television, a signal, quiet, technical, almost invisible to anyone not watching closely. But those who understand what they're looking at know exactly what it means. Because right now, while silver climbs, something else is climbing right alongside it: the cost of America's debt. And historically, when these two lines move together, it has only meant one thing: the system is running out of room. By the end of this video, you will understand exactly what silver is telling us, why it's happening right now, and what may come next if this pattern continues. Stay until the end, because the final part of this story is the one most people won't see coming. Welcome back to Precious Metals Intelligence, the channel dedicated to helping you understand the real forces moving behind the world's financial markets, without the noise and without the hype. Before we begin, I'd like to ask, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see just how far this community reaches, and to know that serious, thoughtful viewers like you are tuning in from every corner of the world. If this is your first time here, consider joining the channel. This community is built for people who prefer substance over sensation, professionals, investors, and independent thinkers who want to understand why markets move, not just that they moved. Now, let's begin. Every so often, the market gives people a clue. It does not shout. It does not send out a press release. It simply moves quietly while most people are looking somewhere else. This week, that clue came from silver. Silver climbed sharply over the last few trading sessions. In just 3 days, the price moved from around $61 an ounce to over $66. On its own, that kind of move might look like nothing more than normal market activity. Prices go up. Prices go down. That is what markets do. But analysts who study these patterns closely say, this move is different. They say it is not just about silver. It is about what silver is responding to. To understand why, it helps to look back at history. Time and again, precious metals have reacted to stress in the financial system before that stress becomes public knowledge. Investors do not wait for an official announcement. They watch interest rates. They watch government borrowing costs. They watch the signs that something in the background is under pressure. And when those signs appear, money often moves into silver and gold long before ordinary people hear anything is wrong. This is what some analysts call the market speaking early. Officials tend to speak last. They wait until a problem is already serious before admitting it exists. But traders, especially those managing large amounts of money, do not have that luxury. They must act on what they see, not what they are told. So when silver moves the way it moved this week, especially while other signals in the economy are also flashing, it becomes worth paying close attention to. What makes this current move even more interesting is the timing. It followed a weak jobs report in the United States. On the surface, weak jobs numbers might sound like bad news only for workers, but for the financial markets, it means something else entirely. A weak labor market increases pressure on the Federal Reserve to lower interest rates or ease financial conditions. And when the market expects that kind of policy shift, precious metals often respond first, because a weaker currency policy tends to push the price of metals higher. Silver's price chart shows the story clearly. Ahead of the jobs report, silver had already been forming a pattern that many traders recognize as a sign of coiled pressure, a period of quiet consolidation before a bigger move. Once the report came out, silver broke through a key technical level, something analysts refer to as the 50-day moving average. This is a line that shows the average price over the past 50 days. When a price breaks above it with strength, it often signals that momentum is shifted. And in silver's case, that break came with real force. There's another detail worth noting. Even during the earlier part of this year, when silver's price fell sharply after reaching a high near $120, something beneath the surface did not fall along with it. A longer-term trend line, tracking silver's price movement over many months, kept rising the entire time. This suggests that even while the price was correcting, the broader direction had not actually changed. Many long-term holders appear to have used that period of falling prices as an opportunity to increase their positions, rather than sell out of fear. This pattern, quiet accumulation during a downturn followed by a strong upward break, is something that has appeared before at major turning points in financial history. It does not guarantee a repeat of the past. But it is exactly the kind of pattern that serious market observers pay attention to, because it often marks the early stage of a larger move, not the end of one. So the question becomes, why is this happening now? Why would silver, along with gold and even mining companies tied to these metals, suddenly show this kind of strength at the very same time the bond market and the energy market are also showing signs of stress? The answer, many analysts argue, lies in a much larger and more serious story, one that has been building for years and is now reaching a critical point. Numbers can be hard to picture. $1 million is already difficult for most people to imagine. $1 billion is harder still. But the number now attached to the United States government's total debt has moved past even that. It has crossed $40 trillion. To put that in perspective, if someone tried to count to 40 trillion, one number every second, without stopping to eat or sleep, it would take well over 1,000,000 years. That number alone tells a story. But the more urgent part of the story is not the size of the debt itself. It is the cost of carrying it. Just like a person with a large credit card balance, the government does not simply owe money. It must also pay interest on that money every single year. And as interest rates have risen over the past few years, the cost of servicing that debt has grown much faster than most people realize. The latest figures show that the United States is now paying more than $1.2 trillion a year just in interest payments. That number is larger than the entire annual budget for national defense. To understand how serious this is, it helps to think about it the way a financial advisor might explain it to an ordinary family. Imagine a household that has taken on a large amount of debt over many years. For a while, the interest rate on that debt stayed low, so the monthly payments were manageable. But then the interest rate begins to climb. Suddenly, the same amount of debt requires a much larger monthly payment. The family has not borrowed any new money. Nothing about their spending has changed. And yet, simply because the interest rate went up, they are now in a much more difficult financial position. This is essentially what has happened to the United States government, except on a much larger scale. As interest rates have increased, the cost of maintaining the existing debt has climbed sharply, even without the government borrowing a single additional dollar, and that cost continues to grow with each passing month. For an ordinary family facing this kind of pressure, there are only a few real options. They can cut spending, they can try to earn more income, or, in the worst case, they may be forced to default, meaning they simply cannot pay what they owe. These are painful choices, and most families try to avoid the last one at all costs. But a national government is different in one very important way. It has an option that a household does not have. It can influence the creation of its own currency. Through its central bank, a government can take steps that effectively make it easier to manage its debt, even if those steps come with consequences of their own, such as reducing the value of the currency over time. This is where the story becomes especially relevant to silver, gold, and other hard assets. Throughout history, when governments have faced overwhelming debt burdens, they have often leaned on this ability to ease monetary pressure rather than make the harder political choice of drastically cutting spending. And when that happens, the value of the currency itself tends to weaken over time. Assets that cannot simply be created out of thin air, like silver and gold, tend to rise in price when this occurs, because it takes more of a weakened currency to buy the same fixed amount of metal. This is not a new idea. It is something that has played out nation after nation across different periods of history. Whenever debt levels became too large to manage through normal means, the pattern tends to repeat, even if the exact timing and details are different each time. What makes the current situation especially worth watching is the pace at which this pressure is building. The interest cost on the debt did not simply rise gradually over many years. It has accelerated sharply in a short period of time, catching many observers off guard. And as that pressure builds, it raises a difficult question for policymakers at the center of it all. At some point, the institution responsible for managing the country's money supply, the Federal Reserve, may be forced to choose between two competing goals. One is keeping inflation under control. The other is preventing the debt itself from becoming impossible to manage. History suggests that when these two goals come into direct conflict, one of them tends to lose. And understanding which one usually loses is the key to understanding why silver may be sending the warning that it appears to be sending right now. Every central bank operates with a set of responsibilities it is supposed to protect. In the case of the Federal Reserve, two of those responsibilities stand above the rest. One is keeping prices stable, meaning controlling inflation so that money keeps its value over time. The other is supporting a healthy, functioning financial system, one where borrowing costs remain manageable and markets continue operating smoothly. For most of modern history, these two goals have coexisted without much conflict. The Fed could raise interest rates to slow inflation or lower them to support economic growth, without one decision threatening to break the entire financial system. But there comes a point when government debt grows large enough where these two responsibilities stop working together and start working against each other. Here's the difficulty. If the Federal Reserve keeps interest rates high in order to fight inflation, it also makes the government's debt more expensive to maintain, since a large portion of that debt must be refinanced at these higher rates. Every dollar increase in the interest rate on government debt this large translates into an enormous rise in yearly interest payments. If the Fed lowers interest rates in order to relieve this pressure on the debt, it risks allowing inflation to grow because more available money in the system tends to push prices higher, not lower. In simple terms, the Federal Reserve is being pulled in two directions at once. Choosing one path helps solve one problem while making the other one worse. History offers a useful guide as to which side tends to win this kind of conflict. When governments accumulate debt levels this large, and the choice comes down to allowing inflation to run somewhat hotter or allowing the debt structure to collapse under its own weight, policymakers have almost always chosen to protect the financial system first. Preventing a debt crisis tends to take priority over preventing higher prices, even when officials publicly say the opposite. This is not a new pattern. It has repeated across many countries and many decades whenever debt burdens became large enough to threaten normal financial functioning. This is precisely why analysts pay such close attention to what is happening in the bond market right now. Normally, when concerns about future inflation increase, bond yields rise. And when bond yields rise, meaning the return investors demand to hold government debt, this usually pulls money away from precious metals because metals do not pay any interest of their own. Under ordinary conditions, rising yields and rising silver or gold prices do not happen together. But that is exactly what appears to be happening today. Treasury yields have been climbing. At the same time, silver, gold, and mining companies tied to these metals have also been climbing. This is an unusual combination, and unusual combinations in financial markets are rarely random. They tend to reflect a shift in how investors are interpreting the situation. One likely explanation is that markets are no longer simply reacting to short-term inflation numbers. They are beginning to anticipate what comes after. If investors believe that rising yields will eventually force the Federal Reserve to intervene, whether through lowering rates or through other forms of monetary easing, then it makes sense that money would begin moving into hard assets now, ahead of that intervention, rather than waiting for it to be officially announced. This is the essence of the warning that many analysts believe silver is sending. It is not simply reacting to today's headlines, it appears to be positioning itself for tomorrow's monetary policy, based on the belief that the Federal Reserve's hand will eventually be forced. Adding to this picture is the state of global energy markets, which have been experiencing their own significant pressures in recent weeks. Rising energy costs tend to add further strain to inflation figures, complicating the Fed's decision-making even more. A central bank trying to manage inflation becomes far more constrained when energy prices themselves are pushing costs higher across the entire economy. This layering of pressures, debt servicing costs, energy market instability, and slowing labor market data creates a far more complicated environment than a simple interest rate decision. Taken together, these forces help explain why silver's recent strength cannot be viewed in isolation. It is not just a technical chart pattern or a short-term rally. It appears to reflect a market that is beginning to read between the lines, recognizing that the Federal Reserve may soon face a decision it cannot avoid, one where protecting the financial system likely takes priority over defeating inflation. And if that is indeed what is unfolding, the next question becomes just as important. What does the price action across silver, gold, and mining companies actually reveal about how prepared professional investors already are for this outcome? That is the story explored next. Numbers and interest rates tell one side of the story. But there is another side that is harder to see in official reports, and that is how professional investors are actually positioning their money right now. Sometimes, the clearest signal does not come from a headline or a government report. It comes from watching what large, experienced investors are quietly doing with their capital long before the reasons become public knowledge. One of the most useful tools for this kind of observation is something called the accumulation distribution line. It is a technical measure that combines price movement with trading volume, and it helps show whether an asset is being steadily bought up by investors or steadily sold off, even when the price itself is moving in a confusing or unclear direction. When silver's price fell sharply earlier this year, dropping by nearly half from its high, many casual observers assumed that investors were losing confidence and abandoning the metal. But the accumulation distribution line told a different story. Instead of falling in the same dramatic way as the price, it declined only briefly before beginning a slow, steady climb, even while the price of silver continued moving lower or sideways. This kind of divergence, where the price falls, but the underlying buying pressure does not fall with it, is something serious analysts watch closely. It often suggests that a large amount of quiet accumulation is taking place beneath the surface, even during a period that looks discouraging on the surface. In simple terms, while many smaller investors may have been selling out of fear during the downturn, the data suggests that larger, more patient investors appear to have used that same period as an opportunity to increase their holdings. This pattern becomes even more meaningful when it is combined with what has been happening in mining company stocks. Shares of companies that mine silver and gold have shown notably strong performance recently, breaking out of long periods of sideways trading. This matters because mining stocks tend to be more sensitive to investor expectations about future metal prices than the metals themselves. A mining company's profits can grow dramatically if the price of silver or gold rises, even modestly, which means investors who buy mining shares are often making a more aggressive bet on future price direction. When mining shares begin breaking out at the same time as the metals themselves, and while broader stock market indexes are struggling to make similar gains, It becomes a signal that is difficult to dismiss as coincidence. It suggests that a meaningful segment of the investment community sees something ahead that justifies this kind of positioning, even before the general public becomes aware of it. This is not the same as saying prices will move in a straight line from here. Markets rarely move that simply, and periods of resistance or pullback are normal, even within a larger upward trend. But the broader pattern, quiet accumulation during weakness, followed by a coordinated breakout across metals and mining shares, all occurring at the same time as rising bond yields and rising energy costs, is a combination that has historically appeared during earlier stages of major shifts in monetary policy, rather than at their conclusion. For business professionals and serious investors, the lesson here is not about chasing a short-term trade. It is about recognizing how markets often behave ahead of major turning points. Officials tend to speak only after a problem can no longer be avoided. Experienced capital tends to move earlier, often quietly, well before that official acknowledgement ever arrives. Taken as a whole, the story building across silver, gold, mining shares, bond yields, and the ballooning cost of servicing government debt does not appear to be a series of unrelated events. It increasingly looks like the early stages of a much larger financial story, one that the market may already be pricing in, even as most of the public remains focused on other headlines entirely. Whether this pattern continues to build in the weeks ahead remains to be seen, but for those paying close attention, silver's recent strength may be less about the metal itself and more about what it is quietly revealing concerning the financial system it moves alongside.